Buying an asset is incredibly simple. It just takes capital. But knowing exactly when to walk away with your gains before the market turns against you requires mastering severe psychological pressure. Most traders struggle to find balance. Fear of a sudden market crash or greed for slightly more profit frequently overrides their logical risk assessment. This leads people to either panic and exit prematurely or hold on to failing assets all the way down. To combat this fear, amateurs often rely on a rigid mechanical safeguard, the fixed percentage stop loss. They set a static boundary, say a hard 5% drop, meant to prevent a total catastrophe. This chart illustrates the problem. When you use a fixed stop, a tiny, entirely normal price fluctuation, what traders call market noise, can trigger that static exit right before the asset rockets into a massive upward rally. Static risk systems fail because they treat every asset and every market movement identically. Instead of providing safety, they turn traders into victims of normal market turbulence. Every financial chart represents a continuous battle between data points. On one side, you have the noise, those meaningless random price fluctuations. On the other side, you have the signal, a true structural reversal in the overall trend. The intellectual challenge is finding a mathematical mechanism that can strip away the emotional noise and identify that true signal in real time. This is exactly what the Chandelier Exit accomplishes. Developed by Chuck LeBeau, it is an algorithmic volatility-based tool specifically engineered to override human cognitive bias. This framework adapts to current market conditions in real time, removing emotional guesswork from every exit decision. To successfully filter out market noise, a system must first accurately measure the specific natural volatility, the heartbeat of an individual asset. We calculate this using the average true range, or ATR. ATR is a mathematical unit that quantifies exactly how much an asset typically fluctuates over a set time frame. Look at these two waveforms. The top represents a historically stable blue chip stock requiring a tight stop. The bottom illustrates a wildly volatile cryptocurrency, which needs more mathematical breathing room to account for its natural swings. ATR transforms abstract, frightening volatility into a concrete, quantifiable data point that drives a dynamic protection strategy. Let's see how the Chandelier Exit applies that ATR data directly to a live trading environment. This diagram shows where the indicator gets its name. It hangs downward from the absolute highest peak the asset's price has recently achieved, establishing a horizontal floor. The standard setup uses a look-back period of 22 bars to locate that highest peak. From there, it applies a multiplier, usually 3 times the ATR, determining exactly how far down the floor hangs. As price reaches new highs, the mathematical floor ratchets upward. Notice what happens when price dips. The floor rigidly remains in place. The exact inverse applies to short positions. The indicator hangs above the price, tracking the lowest low of the period and creating a descending ceiling that moves down as the price drops. This one-way ratcheting mechanism allows the asset to fluctuate within its normal noise limits while simultaneously locking in your accumulated profits. Eventually, every trend breaks. The critical, high-stress moment comes when an asset's price experiences a sudden, severe drop, testing both your resolve and the indicator's limits. In this chart, the mechanical signal is clear. When the price firmly crosses through the established chandelier line, the math proves it is a true trend collapse, triggering an emotionless exit. But there is a danger here, known as the tight stop trap. Reducing the ATR multiplier below 2.5 suffocates the asset's natural movement. A multiplier set too low completely neutralizes the tool's advantage. It regresses the Chandelier Exit back into a highly sensitive, static trap that will shake you out of a winning position. Professional risk management relies on a rigid, repeatable architecture that curtails losses while allowing momentum to run. Open your charting software, apply the Chandelier Exit to your favorite historical data, and observe how this specific framework protects capital. Instead of guessing, let the market's own heartbeat tell you when it's time to walk away.